Hi everyone, September 18th, 2016. Thanks for coming. Welcome to finance class. Got about 150 of you here. I'm sure thousands more will watch and replay. We're here to talk about, continue our sort of thematic lessons. We're going to spend the first half an hour or so delving on kind of a light topic just to get you warmed up. And that topic these days has been in various investors and their styles. These are people not only to learn from their successes, which is often hard, but I actually think one of the best things you could do is get familiar with these names such that you can build your network, which, again, this series is tailored for people who want to be professional investors. And a network is rather important when becoming a professional investor. If you have dreams of being a professional investor, or maybe you are already, or you want to become an even more professional investor, or maybe you're not in investing, so to speak, but you're in some other part of finance and you want to become a more proficient investor. So anyway, let me just do this. I've updated the share drive, so there's all kinds of goodies in there if you want to, any of you really want to go in there and study it, you might find some cool stuff. So last time we talked a little bit about a hedge fund called Tiger, and I have added some slides here. Let me just find them about this hedge fund kind of complex. And before we get to that, I mentioned last time that hedge funds today are a little bit different from the way they were 10 or even 20 or even 10 years ago. Fees and are a little less important. Performance is a little less important, I should say. Fees are always the most important thing, and I'd say that hedge fund would much rather be a $20 billion fund with lower performance than a $2 billion fund with high performance, and if you do the math, that makes a lot of sense. Pedigree is certainly still an important predictor of success. It's not the only predictor, but it's important out there. I wanted to mention this trend, and when we go to the hedge fund we're going to be talking about today called Viking, this trend of more and more hedge funds being involved in private equity is very important. I think that without this sort of shift is emblematic of an important systematic factor in hedge funds, which is a search for outperformance that is often coming up dry. And then finally, activism, which was sort of the old private, sort of the old, sort of put in here, 2000 to 2010 source of extra alpha, and then here maybe it's 2011 to 2020 source of extra alpha. But I think it's safe to say that activism as a source of investment return is sort of dead. But a lot has been written on that besides what I have to say. So anyway, there's we talked a brief amount about Tiger last time. I kind of introduced it to you guys. There's a book. I don't necessarily recommend it, but it kind of chronicles Julian Robertson, who started the Tiger complex. It's called Tiger. Julian Robertson, A Tiger in the Land of Bulls and Bears, and it's by Daniel Strockman. And again, it's not an exceptionally good book, but if you're really a hedge fund aficionado, you can read it. There's actually a link to the book in this PowerPoint. I don't advocate that you click that, but it was interesting that I found that online when I was Googling around. So if you want to read that book, you can just click that link. But again, do so at your own risk. So the Tiger funds operated from 1980, not 1998, 1980 to 2000. And so they had about a 20-year track record, and they returned about 32% over 20 years, which is really a remarkable result. And there are only a few down years, and none of them were too terrible. So this was one of the greatest track records ever in hedge fund history. This is why Julian Robertson is a bit of a legend in the investment field. Julian's about, 82, 83, something like that. Last time I saw him was 4 years ago when Mitt Romney was running for president. I know Julian is a huge fan of Mitt Romney. So Tiger closed in 2000, but it kind of closed in a weird way. It sort of closed in the sense that it wasn't a hedge fund anymore, but 32% every year. So CAGR is a compound annual growth rate. So you could do the math on that. It's you could think of it like this: 1 times 1 plus 0.32 to the 20th power. It's a 258 multiple of your money. So pretty incredible. $1 million would become $258 million over 20 years. So 32% rate of return. Of course, the Renaissance hedge funds are slightly even better than that. But yes, that's probably one of the greatest hedge fund returns of all time. And that's why Tiger is so adored and important in the hedge fund community. So in any event, when Tiger closed, there were a number of Tiger funds that left. Left the. Well, I can just briefly tell you what kind of money that means. At its peak, Tiger managed, say, 20 billion. But let's pick one year where they managed 15 billion. Let's say they made 30%. So they 32%. So that's just say 30%. So this is their assets, 15 billion. This is their profits, and traditionally you keep 20% of those profits. So this is the management fee. This is $900 million, and this is let's say 2% or 1.5% of assets under management is also a fee. This is the management fee. This is the incentive fee. So in a year like this, say this was 1998 or 1997, I don't know. This would be a $1.1 billion payday. Now, having said that, you do have to divide that over 100 employees or so, and obviously not everyone gets the same amount, but maybe 500 million goes to Julian Robertson, and 500 million gets split up amongst 100 people, which is 5 million a person, but obviously those 100 people aren't all created equal. Maybe there's 50 managers, and they all get 10 million each, something like that. That's sort of how a hedge fund works. So in any event, what's interesting is this is sort of, even today, this would be one of the biggest hedge funds in the world. And if you think about that number, say 500 million, and this is a phenomenal year, very few hedge funds return 30% anymore. You can think of it really as, let's fast forward to 2016, let's say you earn 10%, and the total fees were 525 million, and say by convention, half of that goes to the founder, $250 million for the founder, or the CIO, or what have you. I think what's interesting is that if you think about what's easier, to make $250 million building the world's biggest hedge fund, or one of the world's biggest hedge funds over 20 years, and then having a good year, or is it easier to actually start a company worth $250 million? And I actually think, I did this math many years ago, and I actually think it's much easier to start a company that's worth $250 million than start a hedge fund and have that hedge fund create all this value. Now, you could argue that there's equity value in the hedge fund, and we can discuss that later, but in any event, that's sort of one thing to think about as you think about these fees. This is obviously an enormous amount of money, but at the same time, it sort of makes you wonder if a guy like, obviously there's only one Mark Zuckerberg, but if you can think of companies, we'll talk about Salesforce.com in a minute, we'll talk about companies that Salesforce.com acquired, we can talk about, is this really the easiest path to making money? And that's why I often say that hedge funds and professional investing isn't always a really great choice to create wealth. All right. So when Tiger closed in 2000, there were a number of so-called Tiger Cubs that launched, and we're going to talk about all of them. Today we're going to talk about Viking, which is one of the funds that started in 1999, right at the end of Tiger's long, majestic run. And then there are a bunch of newer so-called Tiger Cubs, and some of them are called Grand Cubs, Great Grand Cubs. There's now 4 generations, I think, of Tiger Cubs. It's starting to get a little silly, but it tells you how pervasive this field is with Tiger pedigree, and we'll talk about those at some point. But in general, Tiger funds are value-focused, they're generally equity-focused, and sometimes macro-focused, but really generally equity-focused. The book has a fun little thing from Julian Robertson about things to look for. I know that Tiger still does sort of these pseudo IQ tests where they seem to prefer these folks who can quickly add and subtract numbers in their head. They do these tests of numeric calculations, which is a little interesting. And then sports is pretty important. Virtually all of these guys had some success in sports or some other competitive field. So these are the two that stick out. I think the rest are all kind of out there, although I'd say the charity aspect is also there. But no one doubts that personality and a good resume are important. Tiger will often hire younger folks, often right out of college, if they meet the right traits, which is kind of interesting. And then the last thing I'd say, I want to add one more thing to this list. Where is it? Yeah, decentralized management from time to time. That isn't always the case, but if you look at a fund like Viking, if you look at a fund like Viking, that certainly is the case at that firm. Everyone manages a portfolio, so it's really a fund of several portfolios. So here's a little map of how Tiger kind of split up. And I didn't quite complete this, and I think you can, I actually looked around, you can't find anything quite like this, so I'm going to keep working on this, and eventually it'll look nice and appropriate. But in essence, you have Tiger, and then these are the real kind of Tiger Cubs. Lone Pine, Viking, Maverick, Blue Ridge, Deerfield, Cotoon, Shumway are all, Shumway is now deceased, so I should probably put it here. These are kind of the dead or sort of not actively managed Tiger Cubs. I actually worked at one of these funds very briefly. So these are the Grand Cubs, Conatus, Impala, Bridger Capital, which I sometimes joke about because the radio DJ mentioned it, JAT, and then there's a couple of funds that actually went from Tiger to Steve Cohen's SAC Capital, and then have their own funds now, Sandlin and Healthcore, too, funds like that. So what's interesting is virtually all of the funds in this list, even the funds that closed down, were very successful. There was no Tiger Cub, at least on this list, that lost a lot of money or anything. So it's remarkable that you have so many folks that kind of had success. Remember, these are all individual firms. These are all individual firms that no longer, that are all independently managed, which is pretty incredible. But in terms of really successful Tiger Cubs, I mean, you're really looking at, let's say, and direct descendants. There are very few. The newer Tiger Cubs, a lot of them have closed. Here's sort of the direct descendants, people that worked at Tiger. Here we go. At Tiger, and then promptly started a fund. Cotu's a little different, but at least these 1, 2, 3, 4, 5 are certainly, it's certainly the case that that these are sort of original Tiger Cubs, and some of these are original as well, but many of them closed, and that is what it is. So let's talk a little bit about Viking. I marked the new things I've added to this PowerPoint, which is now 68 slides in red. Viking is run by a guy named Andreas Halvorsen. I think his first name is actually Ole, or Ole. I don't really know how to pronounce it. And the PowerPoint is in the share drive. And Halvorsen was, or Andreas as people call him, was a top lieutenant at Tiger for many years. He was a competitive skier. He was in the Norwegian military. This is the kind of person Tiger looks for, someone very competitive. $33 billion now Viking manages, so it's one of the bigger hedge funds. I think it's in the top 5, type 6 hedge funds, and certainly in terms of equities only, which is pretty much what these guys do, is stocks. That is definitely the biggest, or one of the biggest hedge funds in the world. What's amazing about Viking to me is that they've been in business now 16 or 17 years, and they've only had 2 down years. And both of them were a little less than 1%, which is really, really incredible risk management. You know, sometimes the returns are also very good. I've said that it's very hard to have more than, say, 10% average annual returns, and I can make a case that it's hard to have any excess annual return. But in any event, this is a fund that has had enormous success on the upside and very, very little disappointment on the downside, which is really a truly incredible performance. It's a small firm. I think there's about 48. There's actually about 148 employees, and about 50 of those are investment related. So you can get a sense for the kind of scale and scope of a business like this. And this would be a perfect place for anyone to work and learn, not learn, but employ, but also learn a little bit about investing. The firm is almost exclusively focused on equities, and so you can easily sort of look up the 13F filings to check out what they're investing in. They do global, although I just looked at some numbers, and I actually have put some due diligence in the share drive. They're, at least in a recent period, their North American focus was 75%. So a lot of these so-called global hedge funds are, in fact, what Viking is called, Viking Global Investors. I've worked at funds like this, and I think this idea that they're truly global is inaccurate. Viking's roughly 75% North American last time I checked, although, again, funds are very private. It's just because you checked 5 years ago doesn't mean that what they're investing in now, but certainly I think a lot of funds say they're global, but they're not really. One of the things Viking does that's very different is they do illiquid investments and venture capital investments, and they do quite a bit of that. So they're often leading a lot of deals in Silicon Valley, which is kind of interesting, and we'll see how that goes. So-called crossover investments and venture investments. They're a concentrated fund, so they'll make their favorite investment ideas 5 or more % of their portfolio, which I call concentrated. They're value investors, but they understand growth stocks, and we're going to talk about that theme probably next video with a description of Lone Pine, which is probably the other extremely successful Tiger Cub. If I had to pick 2, I'd pick Lone Pine and Viking, and then maybe Blue Ridge. But we can talk about that some other time. Viking's a little unusual in the Tiger complex in that it's team run. Each person at the fund has a portfolio, which is not every single person, but the fund is sort of split. The $33 billion is split into different managers, and they have a relatively low net exposure, which is the amount that the fund is exposed longs minus shorts, and we've talked about that before. So a lot of you ask, well, I don't know, that sounds really difficult. How do I get into a fund like this? It's impossible, et cetera, et cetera. Well, you'd be surprised. It's not often as hard as it looks. I made a list of all the Viking employees, and you can do that in LinkedIn, and it's not impossible to actually start contacting some of these people, especially if you find some overlapping thing of interest or whatever. Here are some letters from the fund that I found on the internet, and then I found some really cool things. I found the fund's private placement memorandum and some other interesting things like the fund's audit, and I pasted those in the share drive. If you've never seen a hedge fund's private placement memorandum, you'd really enjoy reading that, I think, since it's one of the most successful hedge funds ever. All right, so enough about Viking, but that's sort of I thought an interesting look at a very secretive hedge fund that doesn't disclose a lot, but is extremely successful. And not all this information is terribly easy to find. But if you want to know what you're talking about in hedge funds, you certainly have to know who Viking Global is. All right, let's take a look. What do we go to next? I'm going to talk a little bit about Salesforce.com. I'm going to wrap that up. Just make sure I don't have anything here I need to discuss. I did mention a couple videos ago that I don't believe equities rise in the long run, that at best U.S. equities deliver 2% alpha above I guess, let's see, just 2% total performance. I shouldn't even call it alpha. Deliver plus 2%. Net of taxes and inflation, but you get substantial survivor bias, which is survivorship bias risk, which is really scary. That's you're taking huge downside risk to get 2% a year, and your risk is that you've misevaluated that the U.S. is special, and I would argue it is not special. So I don't believe in passive investing. I don't think equities rise over the long run, and I would position myself accordingly. All right, what else? This is all good. This is all good. So we'll close these chapters now of our investing class. Great. And I can even minimize this, and we can focus now on Salesforce. So I did this fun thing. I looked back. I built out the model a little bit more. Salesforce.com, the ticker is CRM, in case you haven't noticed. We worked on this last time. And what's amazing is from 2005, Salesforce has this 176 million in revenue. Remember when this company went public? And it grows and grows and grows. You can see the blistering growth rate, 76, 60, 50, 40, 20, 20, 30% growth rates. Really incredible growth rates. And it doesn't stop, 30% up until last year where it was 24%. I think they're guiding to something like a 25% growth rate. So one of the things here is, I guess we can kind of make some new slides here. Let's see. Let's call it growth stocks. And this is going to be a thematic concept, I think, for a couple of this is going to be a thematic concept frequently here. And one of the things that happens often in so-called growth stocks is you miss this idea. You think that there's a law of larger numbers. You think that because a company has grown 76% or 60% or 50%, that they can't continue to grow at this rate. And what you end up doing is you make this kind of faulty model like this, where you just assume that the company just can't grow anymore. It just can't grow anymore. And this is a really silly way of looking at the world, of saying, well, I'm just going to assume it just grows less and less and less and less. And that's a really, really bad way of forecasting. And we'll show you kind of why it doesn't make sense. There are a number of companies like Salesforce.com and Google that have accelerating growth. Facebook is another one. And you can see here that with this year, where they're sort of these numbers in the 20s, that maybe the big growth for Salesforce.com is over, and then they go ahead and grow 37, 35, 33, and 32%, substantially more than these 2 years. And Apple is another interesting case study where Apple had no growth for a decade, and then all of a sudden had this wonderful growth. So it really is not something you can trick yourself into thinking numerically. Sometimes you have to. But what you're really doing when you do something like this, like I did last lesson, is you're setting up an imputed base case, and that's a very different thing from a forecast. And we've talked about that a couple times here. But one of the ways you can sort of forecast whether a company is actually brushing up against the law of large numbers is you sort of ignore focus on total market size. So if you focus on the total market size, you can kind of have a lot of fun with this idea that a company can be just beginning to be scratching the surface of what they're trying to take the market out, take a market share from. So if we look at a couple SEC filings real quick, we go to Oracle's SEC filings. Let's go to their 10K. Oracle revenue, $37 billion. Look at SAP. You're looking for their 20F. It's a little different in this case. It's a European company. Where are we going to find that? Operating results. IFRS is the European version of GAAP. We have a 20 billion, 2793, and that's in euros, which is pretty close to dollars. I don't know, let's look at, those are the closest enterprise software kind of companies. If we have Microsoft, I don't know, let's just say they have a $10 billion enterprise software business, and let's say IBM has a $5 billion enterprise software business. I think I got them all. Let's just argue it's a $100 billion revenue business, okay? And here we have Salesforce.com last year generated six or 7 billion. So think that through. And you might realize that I'm only taking a tiny bit of IBM's revenue, tiny bit of IBM and Microsoft revenue, so the part that would correspond to enterprise software. And it doesn't necessarily have to be 100% overlap, because if you look, and we'll go through it in a second, what Salesforce.com is doing is they're become pretty sprawling. So you're talking about having less than 10% market share of revenue of just a handful of companies. And if you look at, probably there's more than 4 companies enterprise software. Not if Oracle has anything to do about it, but that's just a joke. IBM has bought a lot of enterprise software companies over the years. Just the DB2 is a good example of a big part of IBM's business. Anyway, they compete directly with Oracle on that stuff. Anyway, getting back to the point, there's at least $100 billion of enterprise software revenue. And Salesforce.com is looking at having 6, maybe 8 billion out of 100 billion. So if you think about, okay, over time, can this be a company that has 25% of enterprise software? I mean, remember that pie is growing as well. So if you think about that, I have it never happening, basically. And at this, they're doing something right. You have to argue that they're doing something right by the virtue that the growth rate is as follows, right? And you have to argue that that something right is not going to change tomorrow. That they are the leader in software as a service, which they kind of pioneered, to be frank, with respect to enterprise software. And now you even have the incumbents, the Oracles, the SAPs, etc., actually catching up to Salesforce.com, which is, again, a scary point to think about. So they could easily have a 30% or 35% growth in these years, which would substantially change the model. And that's a really important thing to get. And when you look at great investors like the Lone Pines of the world, they're really, really good at thinking about this exact dynamic. And most investors are not. They sort of think of it like this. They say, well, they can't grow like this forever, therefore the growth rate will drop. Let me take an NPV and see what happens. What you often fail to recognize is that, if I just pop in a couple 30% years here, it makes more sense to understand the dynamics of what's happening at the company level and at the industry level than to worry about the exact numbers. And that's why you see my models are sometimes I'm not painstaking with respect to these models. And it's because really good investing is about being creative more than it is about being painstaking. And if I told you, do you think Salesforce.com can have 25% of the entire enterprise software market share, and you weren't allowed to look at any numbers, you might say, yeah, that actually sounds pretty reasonable. I bet they could. But then if I showed you these numbers, you would say, whoa, that's impossible. Well, they can't get to 25% market share without hitting these numbers. And if they hit these numbers, it's a $200 stock. Right now it's a $74 stock. And by the way, this is after missing the boat on this stock. And so I'm going to have a lot of fun with you guys and show you their stock price every year versus their revenue. And this is going to be a lot of fun. Well, no, I wouldn't say that, Mr. McNamara. That's a pretty foolish thing to say, so please don't spread misinformation here. No one's split up Oracle yet, for instance. Okay, so here's the revenue of the company, which is a decent proxy for their success. And here's their stock price. And what's really interesting is if you think about revenue growth and stock price growth, we know what their revenue growth is. We did that earlier. There's some folks that think these two numbers should track. And what's amazing is that they don't. In fact, here you have the stock price basically stagnant. Here, let's go here. The stock price at 11 to 16, so over 4 years, 5 years. 50% growth in the stock price, right? But a 4x 4x or more, actually, a little more than 4 times increase in revenue. And that makes you ask yourself, well, how does that work? How did the stock price go up only 50% while the revenue went up 300% or 4x? And I think that what a lot of Wall Streeters say is they call it multiple compression, which is a bit of a silly term, and I don't like it very much. But the idea is that that a company that grows 20 or 30% forever is worth close to infinity. That's not a concept that is possible, really. Eventually, some company won't be able to grow. Witness Apple, for instance. Whether it's due to a quote-unquote law of larger numbers or just the fact that it's hard to continue to innovate at that pace. So the market's a discounting machine. And the concept of that is that in 2006, investors know full well that Salesforce.com is growing, right? It's growing 76% year over year. But remember, there's no free lunch. So what a company is trying to do is what the investors are trying to do is understand when will that growth stop. So let's go back in time, and actually this will be a lot of fun, and it'll help you understand the essence of investing. So I'm, of course, at the SEC's website, type 10K, and we're going to go all the way back to the fiscal year 2005. In fact, let's go to 2006 because it will contain the data from 2005. All right. So, 300 million in revenue this year. They had 69 million in COGS, 241 million marketing and sales, 149, R&D, 23, G&A. You can see that it's even like today, it's not really possible to look at the EBITDA line or the operating income line, because Salesforce, just like today, back then kept all of their profit reinvested into the business. So they purposefully, I think, have held down margins, which I think is a very, very smart thing. Most companies don't like doing, and I think is a really good idea. Anyway, let's see the tiny R&D budget relative to today. So again, we're not going to look so much at the earnings, but we're going to look at the revenue, and most importantly, we're going to look at the shares outstanding, because that's changed a lot over the years. So back then, what's interesting is the prices I have are split adjusted, so I think we can actually keep it like this. So there's 662 million shares outstanding right now. Okay. So the revenue per share outstanding is one way to look at this. And if you look at the ratio between the stock price and the revenue per share outstanding, or price, in essence, price to sales, you can see that this is sort of this pseudo multiple. And the multiple is sort of an indicator of how much health the investors are sort of willing to subscribe. And that's why in this case, over these 5 years, the stock price didn't really go up much relative to the revenue, which went up dramatically. And you can see the ratio dropped dramatically. So again, investors starting to believe that perhaps the future revenue growth of the company won't be that successful. But of course it was, and that the stock price had to react accordingly. This happens a lot, and what the whole point here is that the company's the market's discounting mechanism accurately reflected what happened in the future. Let's show you an example where that didn't happen. Let's go to Microsoft real quick, and this is a fascinating alternative to sort of so let's look at Microsoft's annual price from 2000. Let's see, 2020, let's start with 1999. and this was the bubble days. And you can see that Microsoft stock has finally recovered. Finally recovered, even though its financial condition is quite a bit different. And this happens in every industry. It actually happened with Johnson & Johnson. The markets can I wouldn't say they can have their own imagination. They do have their own imagination. They do have their own implicit opinion. It's sort of consensus opinion that occurs through this sort of groupthink, if you will, or mind, sort of all the minds of the market aligning it as one. And here we go. You can see Microsoft sort of round tripping from 58 in 1999, 17 years ago. I remember sitting there looking at Microsoft stock at $70. That was the end of the year. It was 70 earlier that year, or in fact, it was 70 in 2000. And you can see it dropping to 21, staying in the 20s and 30s for a long time, and finally just recovering in the last few years. Now, what about its financial condition over the same period of time? Well, you can see that the revenue in 2004 was $37 billion, and the revenue now is $93 billion. But the stock price was actually higher at one point with much lower revenue. We can go to Microsoft real quick and grab some filings. It won't take very long. And you'll be amazed at how the market can anticipate that high growth companies are fairly valued by the market exceptionally quickly. There's their 2000 fiscal year 2002, 28, 365, 32, 187, 36, 835. So if you just pick 2 years like doesn't look right. I got these backwards. 28, 365, 32, 187, 36, 835. There we go. Almost done. Let's go to 5. And you might be saying, well, this is just due to the bubble, but I don't think that's accurate. This happens quite often. It happens in pharmaceuticals all the time. Let me show you exactly what I mean. The wrong number for 2006. 448, 282, 6835. It's kind of funky. Got these some typos here. All right, one more. It's great the SEC filings go back this far, and they're even hyperlinked. Here we go, 22,956. All right, so you can see what's amazing about Microsoft is they've had revenue growth every year. Every year. I mean, maybe 1 year where they had negative revenue drop. 1 year. Every single year. And you can see the revenue growth has been consistent. You might think that, well, the market can get things wrong with companies that have revenue jumping up and down. Right? But here you have the company with $25 billion in revenue and a $33 stock price, and literally a decade later, 11 years later, the same stock price with $73 billion in revenue, triple the size of the company. And a lot of this has to do with our important aspects like discount rate and sort of theoretical growth, which we, of course, annually, we put in annually, and then, of course, maturity, growth of maturity, and, of course, return on invested capital. These are sort of 3 core concepts. You can just say near-term earnings here, growth and maturity. And so the market is always keeping these things in mind, these four things in mind. And here in 2001, if you could talk to the market, what the market would say is, well, I think Microsoft is the only game in town. There's no risk. Near-term earnings look great. Growth at maturity. Well, the internet's just starting. It's going to be here forever. What a wonderful company. And that's why they were willing to ascribe such a high valuation to it. And of course, if you could talk to the market in 2012, literally 11 years later, it has a lower stock price. So could you imagine buying something in 2001 and then being told that not only did you lose money in 2012, you're down on your investment, but the company's results have been amazing. Amazing. So this is post-crash. This is 2011. I'm not even worried about 1999, 2000 when the market crashed. This is post-crash. So the market is really basically saying in 2012 that the discount rate is higher than it was in 2001. There's more risks to the long-term earnings of Microsoft. Maybe that's due to Apple and mobile, whereas Microsoft in 2001, nobody could envision how much success Apple and the mobile platforms would have. People thought of cell phones as cell phones, not as future kind of replacements for PCs. So Microsoft started here with just operating systems and information worker, we'll call those two. And here it's sort of left with information worker. So that's sort of an interesting sort of concept. So the discount rate seems higher. Near-term earnings seem fine. I don't know that there's any difference between. In fact, you can see the growth is great at Microsoft. But at maturity, we wonder, is this a more mature company, etc. And return on invested capital, well, we'll see if the new CEO can make things work. But again, the concept that you finally have equalized the stock price of 1999, but you only had to grow the company by 5-fold. The market was really smart at expecting the success of Microsoft. The stock price did not grow like the earnings grew. In fact, the stock price was basically flat, while the revenue and the earnings grew dramatically. So you can see here the average stock price growth was very low, while the revenue and success of the company was very high. And this will happen very frequently. And so it's important to sort of understand how that works. Despite that, there is some imputed expected growth, and that's why we do these models, to try to see what people are thinking. Again, right now, the world expects, Salesforce basically expects the success of Salesforce.com to stop, which I think is a little bit draconian. I would imagine that is not going to happen. In fact, if I do this, I get the current stock price of Salesforce.com. So in essence, they have a couple more growth years left, and then it's done. And I think that that seems really unlikely. They are sort of at the top of a trend that is going to continue for some time to come, and maybe they'll even be at the forefront of the next trend. They certainly have seemed to have more foresight than the Oracles of the world. So the old way of running companies, this sort of old enterprise software, Salesforce just seems to have disintermediated. If you look at the other things they're doing, like Heroku, which I'm actually a customer of myself, and their Service Cloud, these are sort of two really kind of different enterprise software offerings that are really unique and kind of cool. So I think that the market's really underestimating the success of the company, and in essence, I'm bullish on it. But I hope I've shown you some sort of interesting, more sophisticated ways to think of things other than plug and chug a DCF and hope for the best. I don't think that's a sophisticated way of investing. It's certainly more sophisticated than, technical analysis or just buying because news is good or shorting because news is bad. But we want to get you to the next level every time, and we'll keep sort of trying to do that. But for growth companies, it's particularly difficult to get this kind of thinking going. Whew! Okay, so that was the introduction. So let's go to the next stock we're going to look at. I picked Adobe. I hope everyone's okay with that. And we're going to continue with this sort of theme of software. Again, it's easier when you are looking at an entire sector to come up with investment ideas and things like that. So let's go to Adobe stock, $98.93. Let's check the number of shares. The stock price in and of itself doesn't mean anything until we know how many shares there are. There's nothing we can determine from the stock price. It's like saying, well, each piece is $99, but how many pieces are there? We don't know. We have to look. This is the 20th lesson, I believe, so there are beginner lessons where I very slowly and patiently talk about the basics of investing. All right, so there's about 500 million shares outstanding. And so every one of them is worth $98, so it's roughly $50 billion. It's a $50 billion company, Adobe. Isn't that amazing? And we know that that's about the size of Salesforce.com, isn't it? About the size of Salesforce.com. Let's see how much cash and debt they have, because that, as we've talked about many, many times, plays an important factor in all of this. All right, 886, 379, 3432, 029. What's amazing is you have companies like Adobe that are a really kind of more established, slower growing business, and they're not doing the things that Salesforce is doing. Like, Salesforce is an extremely aggressive acquirer and investor in startup companies, whereas Adobe isn't doing any of this stuff. And it's sort of telling, I think. It's quite telling. All right. Adobe is growing pretty handsomely, maybe not at the pace of Salesforce. Totally different business model, or is it? And totally different products, at least. All right. You can see in 1 quarter, it's about 1.4 billion in revenue. Which annualizes, if you think about it, to what, 5 or 6 billion a year. Let me take the last year, and you can see they're growing quite handsomely. The product revenue is going down. That's the packaged software. The subscription fees from the online software are going up. And we'll talk more about that. That's kind of what's going on at Adobe right now. And you can see the revenue growth is 20%, which isn't quite Salesforce, but that's still quite a lot. Still quite a lot. All right, let's keep taking a look here. Cost of goods sold, 202,079, so very, very high margins. Gross margins of... Most software has high gross margins. Your developers are your cost there. And cost of delivering the software isn't very much. Then, of course, your next highest expense is your salespeople, sales and marketing, their advertisements, and so forth. And R&D is an interesting cost. It's kind of difficult to account for, but presumably your programmers are working on new software and updates to software. Again, tricky to account for. We'll maybe can explain that some other time. But software has some of the most interesting accounting. Somewhat difficult accounting policies sometimes. ready. Alright, so what can we tell from just one quarter? Of course, not a lot, but we can tell a few things. The company is growing pretty substantially, at least that one quarter. The company has very high margins, very profitable, unlike Salesforce.com. And the operating margins also significant. This is a more mature software company. But if you look at the amount of revenue, it's not that different. And we'll see what that tells us in a minute. All right. Let's quickly look at one more quarter. I don't know what Harambe would think of Adobe, but this gets very easy when you can copy and paste the formulas. You can see quarter over quarter there's not much growth here. That could be a seasonality thing. But again, these are mature products, Photoshop and so forth. Strange tax rate aberrations here. Let's do one more. Good thing about Adobe is they're a classic fiscal year. A little off actually. They have their year ends. Spoke too soon, huh? Year ends November 27th, 2015. This year ended 11/28/2014. Well, there goes that. Here you can see. Well, hold on, let me bite my tongue there for a second. This can be very boring, but it's also, it doesn't take much time, which is a good thing. Especially if you get used to it, this is not very hard, and it's very important information. And again, you can see that the packaged software side, like buying the actual Adobe products, is dropping somewhat dramatically, while the subscription version grows somewhat dramatically. So they're making that transition in their business. And you can see the revenue growth of 20% for many years for a company that had sort of been written off in many ways as a old line company. This has reinvigorated Adobe shares and transformed the company quite a bit. But we'll see. We'll see what that looks like in a second. Yeah, everyone's trying to implement this style of business, there's no doubt. Everyone wants to look and feel like a software as a service company. No doubt that their software is certainly right now very good, and they're able to, as the industry leader and the standard bearer, kind of have these kinds of, probably got some pricing out of that move to a cloud-based system. Higher prices is something I'm very familiar with. Always a good thing if you can charge your customers more and more every year. That is something Warren Buffett teaches. Pretty much all investors understand how pricing power is a very powerful driver for businesses. No communists here, I assume. Munger would be proud. I don't know. He talked some smack about Valiant. And again, my contention is Valiant's problem was bad acquisitions, really, not pricing problems. Yeah, we can go buy the Adobe Suite, see how much it costs. It looks like their transition to cloud is just about done, but maybe it's not. Again, that's sort of got to be careful on that larger number stuff. You can see the revenue growth here, 9%. And who in the world would have dreamed a jump to 21% revenue growth? That's the kind of thing that takes you by surprise as an investor when a company all of a sudden. But if you're prepared and you know what the company is ready to do, and you talk to the company and you listen to the conference calls and you stay on top of your game, these are the kind of things you can notice ahead of time. You can see it also improved their margins quite a bit moving to the cloud, probably because it improved their pricing. You can see their cost of goods sold didn't rise very much, but revenue did. One more quarter. Is it a leap year? I forget. Doesn't matter. When is their fiscal year end? Let's see. November, right? So this is Q416, this is Q316. I'm pretty sure all this is right. Yes. Okay. Let's go do some annuals real quick. What's fireworks? Yeah, no, there's a limit to price increases, no doubt. I mean, you can't just do it forever, and it depends on the products you're selling, obviously. So we're gonna go through that in a minute, and we'll see how much of this was driven by pricing versus new users. It's possible they had unit growth, so don't necessarily assume that it's pricing. Haven't used fireworks, but again, I'm not a graphic designer either. Nor do I know this market too well. But that's why I'm doing this. It's a good time to learn. All right, 4562. That is not the number. I think I messed something up here. Hold on. I think I had these right the first time. Q4. Yeah, I did. Silly me. Take a second to fix. Well, when you're a company, you have to buy software. You can't steal it. That's not a good. It's not a good look, as they say in my neighborhood. Wait, this has to be say November 27, 2015. Yeah, I got that. Okay. Ah, I see what I did wrong. Cool. Yeah, could you imagine a design company saying, yeah, you know, we just steal Photoshop? I don't think Adobe would be too happy. Nor is that company wise to risk, I don't know, prosecution or something. Never smart for a business to steal things. All right. All right, here we go. Let's do one more after this. And you can see the dramatic decrease in product, which is package software that you can buy at a store, like a Best Buy or something, and the dramatic increase in the subscription business. really an amazing transition that was well managed by the company. Basically, could you imagine a business saying, well, we're going to stop selling software this way, we're going to stop selling $4 billion a year of our main product this way, and we're going to start selling it that way. It's really, really big kind of thing to do. It's a colossal task, really. So maybe 10 years after they should have, they transitioned to the cloud like Salesforce.com started a long time ago. It's kind of an interesting parable, or parallel, I should say. Parallel, not a parable, it's a parallel between the two companies, right? Better late than never. In their case, it worked out really well. And you can see that in 2014, they had a paltry 2% revenue growth. And this is why the market values these companies. It's pretty interesting. You know, they have similar valuations. Salesforce.com has a little bit more revenue and a lot more growth. So we're going to talk about maybe, who knows, maybe shorting Adobe and going long Salesforce.com. That would be a classic kind of hedge fund trade. Could be fun. It could be wrong. We might want to go long both of them. We might want to short both of them. It's way too early to tell, but that's the kind of thing that's going through my mind right now. And you can see here that they actually used to have products were more. This is so bizarre. Products were not that bizarre actually. I'm just reading. It's sort of tough to read. You can see the subscription business started from nothing, really just nothing, and the transition has occurred. But what's amazing is even though the transition is almost completely done, revenue really isn't that much more than it used to be. And in fact, in 2013, they shrank quite a bit. Maybe Adobe is a really big short, but we have to think about what kind of opportunities do they have going forward. We're still just barely getting familiar with this company, but again, my mind is racing a million times a minute with the excitement of a potential investment or bet, if you will, in the case of a short. You can see they used to generate $1 billion, presumably this is at peak, in net income. So for there to be a $46 billion company seems a little awkward to me, given that there's not a lot of growth in this very kind of old business. These are old and tired brands, Photoshop and so forth. So this really could be a wonderful short. The company paying dividends doesn't change anything about the business. You can do whatever you want with your cash flow. You can keep it, reinvest it, pay it, give you a dividend, and you could do whatever. It doesn't make a difference. It doesn't matter to me, at least. You really hurt this experience if you talk about things that aren't related to investing. So please don't do that, or I may be tempted to not do these lessons anymore. All right, here we go. That'll occupy my time trying to find you. Okay, one more year, and you can really see that their transition from a packaged software company to a enterprise software as a service type company is pretty amazing. All right, let's see here. But at best, if the company was doing $1 billion in free cash flow, it would seem to me very awkward to want to pay 50 times that amount. But again, we still have some work to do here. But again, you can see that the company is certainly at record high revenue, but I'm suspicious of this. Very suspicious. If you've been in finance for your whole life, you've been using Excel your whole life. It's a little like, I guess, Photoshop, right? Similar to how an artist might be using Photoshop. All right, so here you can see that they really have grown their revenue pretty dramatically. The subscription is still rather small, but you can see they're only at 3.8 in revenue. So they had a small hiccup over these last 4 years transitioning to the subscription model, but they really are a growth company in many ways. Let's keep looking though, because I'm not satisfied with just a couple of years. It doesn't take much time to plug them in. And I think this is interesting to look at the landscape of company over a decade and look at their financial performance. Remember, as you plug in these numbers, these are thousands of employees working hard, millions of customers. Really an interesting thing to behold in many ways. And all available for your consumption on the SEC's website, which is pretty neat. It's the biggest design company in the world, but they can't hyperlink their HTML file. They should use Dreamweaver for that. So you can see the subscription business just starting here in 2009. And really rapid growth. Muy rápido. 3 billion, 3.8 billion, 4.2 billion. Then this lull in this transition period, and now 4.8 billion. Thank you, Amber. Right, almost done here. I'd like to look at one more year, would you? Again, to me, fascinating to see the development of such a household name, really, Adobe. Who hasn't heard of Adobe? Such an ever-present name. And we'll get to see, finally, how much money they actually make on things like Acrobat, which I would imagine is not a lot. I think they make most of their money on Photoshop, but I don't know for sure. There are definitely companies that are too expensive, no doubt. That's the underlying kind of. Here they have the links in this document, but on the other ones, there are companies that are way too expensive to invest in. That's the whole point. You can have a great company, but if it's not the right price, it's like a bargain, right? It can be a fantastic, meal, right? It could be the best burger in the world, but you wouldn't pay $1 million for it. If there was a burger just as good at $200 instead of $1 million, and then there was a burger maybe half as good at $10, then a total trash burger for $5, you got to decide which to go long and which to go short. But it has to be relative to the value that you're getting. There's a good burger here. The best bang for the buck is at a place called PJ Clark's here in New York. PJ Clark's is half a mile from here, and you can get a great burger for not a lot. $10, $8, something like that. It's a sit-down restaurant, but it's something else. So here, I was just about to give up on looking at these numbers, but you can see here they go from 3.6 to 3 to 3.8. So you have this really weird growth pattern that is kind of emblematic of a mature company. It's fascinating to me. I'm more and more convinced that the stock is short. But again, I have to hold back my feelings on that and just chill out for a minute. And let's look at one more. I keep saying let's look at one more, and then we find more and more interesting data. So here's 2007. The company does not have any subscription revenue in 2007. So they decide to join the cloud in 2008, which is, not bad. I mean, the cloud was just kind of getting started in 2005 and 2006, so Adobe wasn't too late to the ball game. But you can see that despite the going to the cloud, they didn't gain a whole lot. Maybe they perpetuated their franchises and they guarded against threat, but it doesn't look like they've gained a whole lot. So if you want to calculate what is the revenue growth, you do rate, number of periods is 8, 2015 minus 2007, and you can actually do this negative here, positive here. See, the compound annual growth rate was 5%. Not quite what we've seen from Salesforce.com, which was, I don't know, let's over the same exact period, let's actually see 2007 to 2015. Yeah, it's going to be an interesting number. 35% revenue growth versus 5% for Adobe. So to think of them as a software as a service company, it's a little bit nonsensical. Yeah, I always assumed Microsoft will eventually buy out Adobe, but right now it's rather expensive. I'd pay $20 billion for Adobe. I wouldn't pay $50 billion. And what's remarkable is if you look at the operating income, it's been a consistent $1 billion since the company started. And this idea that they're a much different company now is a little bit ridiculous. Let's take a look at the stock price over the years. I'm going to use Bloomberg, but you can use Yahoo Finance or anything else for that matter. So in 2007, the stock was $42.73. So this is a little bit of the opposite example of what we were just talking about with Microsoft, and that's why these you can really take advantage of situations like this. I love taking advantage of situations. Sounds creepy. All right, so here you have this rapidly rising stock price, right? Rapidly rising stock price, but no change in business conditions. I mean, the company's a little bit bigger, but it's not double bigger, which is the stock is, right? There's more shares outstanding, so you want to be a little careful. There's less shares outstanding, but what's kind of interesting is the EBITDA hasn't changed. It was $930 million in 2007. It was $973 million last year. But the stock price is double where it was at. People think, again, why is that? Well, ROIC, discount, near-term earnings, maturity. People think that the discount rate has dropped. It's dropped because the company successfully transitioned from packaged software to software as a service, which is their big risk, because that the internet would make these things disappear, right? Near-term earnings, well, they're sort of growing nicely right now. 16% revenue growth is more than they've had in a long time, and that for some reason their maturity and long-term investments are probably unchanged. But the market certainly thinks that this level of $1 billion is not created equal from the $1 billion they were making in 2007. That it's more secure, or it's more prone to grow more quickly now, or certainly subscription is nice because you know that the money's coming in. If the user has to cancel their subscription. So that's called visibility. You have excellent visibility that the earnings are going to be good. Whereas every year, hoping and praying that someone's going to buy the package at a Best Buy or wherever was something that was a little more unusual and difficult to forecast. Having said that, I don't buy it, and I think the stock could be short, but we'll have to keep examining this. Let's take a look at, especially given the kind of margins they have for the kind of software they provide. Have to do a survey of some graphic artists or whoever their customers are, and go through that. So let's look at a most recent 10K. Let's see how the company describes themselves. Yeah, so the discount rate would be lower if the business is more stable, which we all know is good. So of course they immediately say software as a service. That's the buzzword, but that was the buzzword 5 or 10 years ago. Let's see how they can. Creative Cloud, Photoshop, Illustrator, Premiere. Let's write these down. Creative Cloud, Photoshop, Illustrator. I'm assuming you can use all of these at once. Premiere Pro, Photoshop, Lightroom. I guess that's the opposite of Darkroom. And InDesign. All right. Adobe Stock. So there's stock images and things like that. Behance community. 5 million creative professionals. That's kind of neat. Dreamweaver is even a product anymore. Let's see, digital media, Photoshop, Elements, Premiere, Elements. These are the basic software. Digital Publishing Solution, Typekit, some mobile apps, really. Document Cloud. I suppose that's PDF or Reader. Acrobat. Alright, let's take a look, see if they segment this anymore. Hard to tell what the difference between Illustrator is and Photoshop. I guess it's in the name, isn't it? No, Premiere is video, right? Well, Lightroom, After Effects. What about these? InDesign, page layout. So let's see, other offerings are from Apple, Autodesk, Avid, Corel. Let's see, Avid, Autodesk, Apple, Corel, Microsoft, Quark, Getty, Shutterstock. Digital marketing business. I don't know what that is. Shantanu Narayan. It's like an Adobe lifer, huh? 1998 to 2016, almost 20 years. So we have to keep track of these subscriptions and things like that. It really does look like their transition to this model is going to increase revenue ultimately. It may not look like it right now, but if you look at paid subscriptions, was 6.167. So we're going to have to keep track of that. And some of these other metrics, we're going to look over them for a second, but here's their reportable segments of digital media, digital marketing, print and publishing. I'm totally surprised. Digital media, $2.2 billion, digital marketing, $0.9 billion. This is out of subscription revenue. Prefer to look at it like this. So it looks like it's been 2/3 digital media and 1/3 digital marketing. Adobe Campaign. Sort of like probably what Salesforce does. Maybe more around sort of ad campaigns. Oh, one last thing about Salesforce.com that I noticed as I was looking at the company. They have a really US-centric kind of base. So you can see here that US is, or America is 70, which is mostly US, is 73% of revenue. And as we know that there's a lot of these enterprise software companies in Europe and Asia Pac will probably become customers over the years, which is probably good fuel for further revenue growth. Another reason to be bullish on Salesforce.com. Well, they mentioned Corel, so I don't know why they would do that. I don't know if Corel died, but I'm kind of curious actually myself. What happened to Corel? Well, looks like it exists. Corel, Aftershot, etc. Corel Corporation. Doesn't look like they died. Looks like they've got a lot of competitor products. Even if they don't have, even if they're not. Hey guys, sorry about that. I very unwisely positioned my foot on the power button. Got about half an hour to go in today's investing lesson. Promise I'll give you these extra 5 minutes. It was not Hillary's fault. Don't blame her for everything. I'm going to test Microsoft's auto recover features here. I gotta upgrade my foot. Make sure I don't hit the monitor. Alright, show recovered files. Okay. Thankfully I saved quite a bit. In the compulsion of pressing Control plus S. If you want to learn Excel hotkeys, you can go study them yourself. Alright, Salesforce.com. How about Adobe? Alright, I got all of it. Doesn't look like I missed anything. Alright, so we could just jump back in. Okay, so I think we got a picture of what Adobe does. We got a picture of sort of what their financial situation is. Let's now look at the near term. I think it makes a lot of sense to look at the near-term situation and really try to understand if this move to cloud is going to propel them to the $5 or $10 billion revenue situation, which is kind of what they're going to need to go to justify the stock price. So here's the this is their conference call script, the 10Q, earnings press release. Let's just look at the press release. Creative growing 37%. All right, let's write that down. Creative. So here they're saying creative was 755. So this is basically Photoshop, right? And the same deferred revenue principle applies to Adobe. It's a very important piece of the puzzle here. June 3rd, 2016. Oh, I mean, I do this for every company I look at, absolutely. Especially if they're financially oriented, like they have products, for instance. Even if they don't have products, they have future products, like a pipeline. This is the same sort of method. All right, so here's the all-important deferred revenue. As we all know, deferred revenue is revenue the company hasn't collected yet. Sort of an interesting concept. Services provided, but revenue has not been booked. Yeah. Balance sheet, and you can guess what's next. Cash flow statement, of course. We have 3 months ended here. Very close model net income and reported net income. We have all the add backs. Of course, stock-based compensation, which I don't view as a proper or appropriate add back. Deferred revs, working capital. You have cash flow from operations of around 500 million, 489. Okay, now we're going to try to do our own free cash flow type of understanding. So here's obviously CapEx. We have investments, which don't really count. And of course acquisitions. Oops, screwed all this up. It's always interesting to but fill out the acquisition line, because you can see sometimes even this really small acquisitions that are done. A lot of fun. So we can actually do our own sort of cash flow from operations. So we'll do cash flow from operations and add back stock-based comp and add CapEx. And this gives us a really much better look into real cash flow, and we can see that it's 349 million. So 349 times 4 is 1.4 billion, which is still 33 times earnings, which I think Salesforce.com is a much better deal than that. those are 3 cash flow statements. A little weird that I get a different number. Oh, I see. That's why. Perfect. Cool. So that's a little bit of surgery on the income statement and cash flow statement there. And you can see that the non-GAAP net income is 357, which is very close to our surgically derived kind of non-GAAP net income. I always like to see. Let's check out one more press release. And it's weird because they give out pieces of different information from time to time. It's kind of interesting. Here's Creative 733. But the subscribers, I'm kind of curious how many subscribers they have. They give this ARR number, which sounds very important. We got to look at that in a minute. Here's the all-important deferred revenue, which is a indicator of future revenue. See, it jumped a little bit quarter over quarter. Definitely a good sign. But we got to think about how much it has to go up. Deferred taxes. Let's take a look here. Reported net income, model net income, very similar. Do all the add backs. Some working capital adjustments there. CapEx, pretty modest. CapEx is lower than D&A, which is telling you that earnings are being under or overstated, everybody. CapEx is lower than D&A. Or earnings understated or overstated. No, earnings are understated because D&A depreciation is higher and CapEx. CapEx is future depreciation. D&A is the D&A that's being removed from the income statement, and CapEx is capitalized on the balance sheet. Excess tax benefit. Okay, so it looks like 2 quarters in a row they had roughly $350 million of our kind of definition of real free cash flow, which is very interesting. I mean, you know, it's only 2 quarters, but it's still important to look at. Looks like maybe URL error here or something. Maybe not. Come on, Adobe. You can find it here. Well, looks like my internet's broken. Or something's broken. Let me see for a minute here. Mike asked a good question earlier, which is how do we look at deferred revenue, and it is on a year-over-year basis. And we know that Salesforce.com has a little bit of a different perspective on unearned revenue, and they even have like unearned and unbilled revenue, which is kind of an interesting perspective. So we got a good flavor of Adobe because I'm having some computer difficulties. I think I'm going to cut this one short. Appreciate everyone coming through, and we'll continue this one where we left off next week, and we'll probably do, let's see, what else should we do? My guess is we'll do, we can do SAP or Intuit. Actually, let's do Intuit since it's a little easier to understand. So if anyone wants to play along, you can make a model for INTU, Intuit, and send it to me at shkrelimartin@gmail.com. shkrelimartin@gmail.com. My name, last name, first name @gmail.com. And I look forward to seeing some of your models. And we'll be here next week, same time, same place. And I'll sort of pick up the Adobe lesson where we left off. So thanks again for coming. Really appreciate it.